Great. So thanks everybody for joining. My name is Aaron Perman. I'm a partner at S3 Ventures, the largest venture firm that's in Texas and focused on Texas-based entrepreneurs. And our webinar today is Treasury Best Practices. And so really trying to help every startup get to know what they should know about protecting and growing their cash. And so we've got two fantastic panelists, Kristy and John, who will get into their intros and backgrounds later, but a couple of quick housekeeping things before we start. So this is a Zoom webinar. Everyone on the webinar is in listen-only mode, but we would welcome and encourage your participation. So, as you have questions during the webinar, please go ahead and submit them using the Q&A button, and then we'll try to work them in, during the webinar or at the end of the webinar. We'll also have a couple of polls, so we would love if you all participate. It'll help make it more interactive and let us better target the content based on the audience. And then later this week, we'll be emailing out a recording of this to all registrants. So if I put my foot in my mouth, it will live forever. And just to go into the agenda, well, like I said, we'll get into some quick introductions. We'll do a couple polls just to better understand kind of who's with us today and what's most relevant. We're going to talk a bit about cash management, and I know that historically maybe this wasn't the most exciting topic, but it should be real exciting because we have portfolio companies that are seeing hundreds of thousands a year of interest income in the current environment, and so there are ways to do that effectively. And then we'll just give you a little bit of perspective on the current capital environment, since both on the debt and equity side, that's I know a hot topic and related to this. And we'll try to leave a few minutes at the end for any additional Q&A we didn't get a chance to work in during the program. So like I said, we got a great panel today. I'll just go left to right, and I'll start with John. And John, if you could just kind of introduce yourself and your background and tell us a little bit about what you do at LeanDNA, and then Kristy, I'll have you do the same.
Sure, sounds good. Thanks, Aaron. Glad to be here today. So my name's John Eckman. I'm the CFO of a company called LeanDNA, which is a S3 portfolio company. My background really was largely on the private equity side. So I was on the investor side for a long time, about 15 years in various forms, middle market buyouts, large cap buyouts, and some growth stage stuff too. And then in that, I sort of transitioned to the operational side about a decade ago, and I've been the CFO of basically 3 smaller software companies, sort of sub 30 million in revenue software companies over the past decade.
Great. And Kristy, great to get your introduction and background as well.
Sure. Kristy Ramundi. I'm Chief Accounting Officer at Alkami Technology. We went public in April of 2021. And prior to that, of course, S3 was one of our largest investors and still is. And prior to that, I started my career in corporate tax, which I know everyone thinks is totally boring, and spent a long time also working through risk management as well as leading internal audit, getting 3 companies ready to go public. So here I sit, Chief Accounting Officer, and so I have Treasury and all other cash management under me as well.
Great. Thanks, John and Kristy. Excited for the conversation today. And so jumping into that, and I'll pull this up. Want to just do a quick poll to get a better sense of who we have in the audience, as that'll help, tailor this to y'all. And so, great to see what best describes you, understand what kind of startup CEOs and founders we have, the number of kind of CFOs or controllers, service providers or consultants, investors, or people in other roles. So I'm going to launch the poll, and I'll leave it open for, 30 seconds or so. And would be great to get as many responses as we can, as that'll help us tailor the content. All right, I'll give it a few more. We got 65% participation. Can we get to 75% of people answering? We're at 70. All right, we're almost at 80%. Let's see if we can get one or two more answers, and then I'll share the results. All right, 79% it is. So great mix in the crowd. About a little over half are either startup CEOs or founders, or startup executives, CFOs, controllers, or similar. And then we have a good group of investors, service providers, and others as well. So here we go. Now the results are shared and you all can see them. So it should be a good group that hopefully will benefit from the discussion today. So now one more fun one. Would love to hear how much attention, especially the startups on here, paid to cash management prior to the SVB collapse. So I just curious, prior to that, how many companies just had all their cash in a checking account or optimized in yield, but compared to how many before the SVB collapse were focused on things that reduced risk? All right, we'll see if a couple more people respond, then I'll share these results as well. All right. Okay, so it looks like, the plurality kind of just had all their cash in a single checking account. We had a good group of folks that were focused on yield optimization, but not necessarily avoiding uninsured deposits. Only 18% actually were set up to avoid uninsured deposits. And then good news, it looks like you all trust banks, so I think that's a good thing. So no one was keeping the cash in a crypto wallet or gold bars or under your mattress. All right, one last question for y'all, just to see. I'm curious how this has changed post SVB collapse. How do y'all manage cash now? I'm just curious how much of the group has changed, if we're going to get almost identical results here.
Aaron, I learned a new term today, I guess. Air-gapped crypto wallet. That's a first.
Hopefully, if you have money in a crypto wallet, it's not connected to the internet.
I'll have to keep that in mind.
All right, got a good group response. Okay, so very interesting. So I'll share the results here. And I think I'm going to show some data in a minute, and this actually is remarkably representative of the data, where we got a few folks that are still kind of all their cash in a checking account, but for the most part, people have put shifted a lot of deposits into ICF or off-balance sheet money markets. We'll talk about those as we get into it. Kind of different methods to keep their cash safe, if their bank were to run into some turbulence. And so what's interesting about that is if you take a look at how startups are handling their cash in general, we pulled some data. So one quick stat is, if you look at JP Morgan has like an equity research coverage universe of basically, all the big regional banks. And so looking at the insured deposits as a percentage of total deposits of all the different regional banks in their equity research, from Q4 22 to the end of Q1 23, insured deposits increased 66%. And so that's from 53 to 66%. And so I think the data we saw in y'all is largely consistent with startups are moving to more cash in insured deposits, whether it's spreading cash across different banks or using ICS to kind of automate that in the background. And then we're seeing a lot more companies have bank accounts at least two or more banks. And so I thought this was interesting as well, where historically a lot of startups would just have accounts at one bank and just even if it's not necessarily moving their capital equally among banks, that the banking diversification is something that we've seen a lot since. And so I think though, just going back to like, as you think about cash management, keep in mind, what's the #1 job of a startup? To make payroll, because you can't do anything else if you don't make payroll. And so we just always keep that in the back of our mind when working with our portfolio companies on keeping their cash safe. So with that, I think let's jump into the discussion. Here's some of the topics we're going to cover. But just to start out, I know, Kristy, you kind of gave your background earlier, but especially at a company your size, because historically and really since like 2008 till 3 months ago, cash management was the domain of typically larger companies, where smaller companies, they couldn't get enough interest on the cash where they were really worried about it. And without a recent bank collapse, it's incredible how short memories are. It just wasn't a priority. And so really it was, historically the domain of companies that were closer to Alkami's size or bigger. And then, two things happened. You had the banking turbulence, and then, now we're seeing startups that have $5+ million of cash making 6 figures of annual income if they do it right. And so all of a sudden, this is becoming a thing. And I think startups, there's a lot we can learn from, bigger companies that have had treasury functions kind of forever. And so, Kristy, I would just love to hear some thoughts from you on kind of your treasury function, kind of your role, how that works, and how that works at a company of your size.
Sure. And I can give a little bit of background. While I wasn't here in the early days of Alkami, I was here when we were still doing capital raises, our crossover funding raise, our Series F raise, which was really our crossover to get us to going public in April of 2021. And you look at our balance sheet today, look at our balance sheet as of March 31st and of 2023, and you say, well, you've got 185 million on your balance sheet, what's your problem? Well, there's, it's managing it as well. It is making sure that you are doing several things. And I also listed our primary goals when it comes to treasury management. And the very first one, as you mentioned, was paying the employees. Our second one was paying our vendors, ensuring we have a way to receive payments from our clients, limiting our risk in where all of our cash is sitting, and then getting the best return on the cash that we have. So when I first joined Alkami, we had only one banking relationship. However, we did have several different accounts, which I encourage, which is an operating account. And then because it's very low cost, it's very low management from a logistical standpoint, having separate accounts for paying payroll and those zero balance accounts that automatically pull from your operating account, and using an insured sweep account to replenish that operating account automatically when you need it. It is very easy to take your sweep account and put it into, not money market, but other funds that provide you overnight liquidity should you need it. And again, for very low bank fees, there's the ability to set up an automatic sweep account where you can keep that money off of that one banking relationship's balance sheet. And that's important because you want to make sure that your assets are insured. When I first joined Alkami, we had only one banking relationship, and that was the setup. We then moved also to SVB. We now have 3 banks in banking relationships, and so we have our money in 3 different banks. But we're actually mirroring the same setup with a sweep account, various ZBA accounts that pull from the operating account. We're mirroring that since the SVB situation. We're mirroring that at 2 other banks so that should something happen at one of those, we can flip the switch and process files and make sure people get paid, make sure vendors get paid, And still at each one of those banks, keeping everything either in a sweep account or off in other investment accounts and keeping it off of the balance sheet of our primary bank relationship. So we're doing a lot of those things now. But if I think about, like I say, when I first joined Alkami and we didn't have that level of cash and we only had one banking relationship, there's still something that you can do to keep anything that's over the insured amount off in another account and off that balance sheet, diversified somewhere else to protect it.
Hey, Kristy, real quick, and John, I want to jump into your setup as well. But Kristy, just for folks that maybe don't know, could you just walk through what a sweep account is?
Sure. A sweep account will be invested in overnight investment accounts that provide overnight liquidity, and it automatically works. You set up your operating account to tell it what you want your daily balance to be. Currently, we have ours set at $1 million. So when you look at something that, and that's what sits on our SVB, which is now First Citizens, our SVB balance sheet is $1 million. Everything else, payroll automatically pulls through the payroll account from operating and funds payroll, funds benefits, funds everything else. Our lockbox automatically sends money into our operating account, and everything is anything over $1 million is automatically swept to that sweep account every night. And if funds are needed to fund payroll or else, it's automatically pulled from the sweep account. So there's no more than $1 million sitting on that balance sheet or on that in the assets of that bank that are at risk at any one day. So you can definitely limit your risk that way.
That's super helpful. I just make sure I understand. And then that money in that sweep account gets basically sent out either into, off balance sheet funds or investment treasuries, or into even other banks at kind of $250,000 increments, right? Something like that.
That's correct. With First Citizens, formerly SVB, what we do, we have those in Morgan Stanley accounts and other various accounts. The majority of our funds with First Citizens are held in custody at another bank, and those are the ones that we invest in treasuries, U.S. treasuries. We have a board-approved investment policy that requires a certain level of credibility for our investments, but the sweep account is held in other investment accounts, but still that give you that overnight liquidity. Now, in another one of our banking relationships, we have taken our excess cash and we've put it in what you are describing, which is more, it is a sweep account, but it's held in, it's across, I think there's a consortium, I guess you would call it, of about 3,000 banks. And we hold it actually in cash at no more than $250,000 at each bank, still providing us overnight liquidity should we need that or want to use it for an acquisition or anything else. But it diversifies those funds across all of those banks, leaving us completely insured at that $250,000 level.
Super helpful. And John, I know, LeanDNA is a little smaller than Alkami, although one day I'm sure you'll be just as big. I'd love to just tell me a little bit about the kind of, what your setup looks like with your finance team. I assume you don't have a treasury role on your, on your team. How do you kind of handle and manage everything and just kind of at your scale?
Yeah, we are a much smaller company. I'd love to have 185 million on my balance sheet. We're working on that, but we're just, for a little context, we raised a Series B about 3 years ago. We raised a small venture debt round back in December of last year. We're kind of preparing, looking out over the next 12 to 24 months for a Series C. So that's kind of the stage we're in. And I have a pretty small team. I do have a controller, a senior accountant, and 2 staff accountants, but they're all fractional resources. So that's kind of the size and scale of us. So basically, the controller and I handle all the treasury-related activities, and we don't have a massive. There's 2 things. We don't have a massive cash balance to try to figure out like all the stuff Kristy was talking about. And we also, we'll get into this later, I'm sure, with some of the other questions. We're a bit locked into our current lender. We can't go outside of our current bank right now, given our credit facility. So that presents some challenges as well. So, internally, we have a couple accounts set up with our current lender to get a little bit higher yield on a money market account, but it's a much simpler setup than what Kristy described, obviously.
That's helpful. Hey, we got one question from the audience kind of along those lines of setting up, and maybe Chris, this one might be a good one for you. As someone was asking, where is the controller for the sweep rule? So you're kind of talking about the sweep rules. Like, is it in the bank treasury management platform where you set the rules on like how much cash sits in the account and gets swept? Is it like a brokerage account, a GL system, another software platform? Like, how do you operationalize some of what you're talking about?
Yeah, it's within the First Citizens or SVB bank setup is where that is. There is because those funds are temporarily held in other investment funds. There are some other documents and custody agreements that are related to that, but the setup of that is not entirely complicated. It's and like I say, it does provide a great deal of risk protection, risk management.
Are we talking like a day or two of work to get it set up if you're motivated and focused, or are we talking kind of, give me some sense of that?
Like a week.
A week. Yeah. And I assume your bank will be helpful as you figure that out, kind of help guide you through it.
Absolutely. Yes.
Got it. That's super. Well, I know you were talking to Kristy, you kind of spoke to kind of your objectives when it comes to cash management, but any other like objective or considerations to add, or John, anything from your perspective as you kind of think about how just sort of the high level strategy before we dive into the details on the what?
No, it's definitely like I'm sure a lot of the viewers here. It's how do we make payroll every 2 weeks, right? That's our primary focus. So we're constantly looking at the cash balance, which account it's in, and be ready for payroll. And I'd say that the objectives have definitely changed since over the past 3 or 4 months since Silicon Valley Bank happened. Protection of cash would be a primary objective. And if we weren't hamstrung by our credit facility, we'd be doing things a little differently. So but that's a focus that frankly we didn't have before April or March or whenever that happened. And then with interest rates continuing to go up, starting to look at better options for getting a little bit of yield on the cash for sure.
Yeah, and John, I would say I remember, I vaguely remember when I first joined Alkami, we were strapped with our credit facility as well at the time. So I completely understand that. And so, working toward being able to bring someone else into your credit facility is not only important, but it does mitigate an enormous amount of risk. It gives you another bank where you can mirror your processes. If I think back when I first joined Alkami, because I came from another technology company where I led risk management and internal audit, not specifically Treasury. And so I came into this being, full transparency here. I came into this 4 years ago and Treasury was put on me and there was something to learn. We were at a smaller bank back then, but there's still even the smaller banks. And of course, we provide digital banking technology for small banks and credit unions. So I know a little bit about what we can provide, but there's a lot of automation that you can avail yourself of, especially when you have a really small team like you just described, John. You have only 5 or 6 people of creating ACH batches and getting your vendors to be ACH. I mean, there's an enormous amount of efficiency that you can avail yourself of, even if you only have one banking relationship currently, just to save yourself that time. So you can spend that time on your cash forecasting. So you can spend that time on, how do I manage my cash rather than just how do I process these daily transactions. ACHs and things like that, that really don't cost a lot of fees. We put all of those things in place about a year after I joined, but had those been in place for the years before, that could have saved a lot of time for the staff. And so I would say even the small banks, and even if you only have one relationship, setting those things up and having those processes automated and in place with whatever accounting system you're using, it will also, if you do need to pivot to another bank, you already have all of the files built. You already have when the SVB issue happened, we pivoted to another bank where we did have cash sitting in an operating account. And we were able to pivot all of our ACH payroll files and everything else and test them out within 48 hours to make sure we could make payroll and pay our vendors. So that automation is not only time saving for you, would be time saving for anyone today, but it gives you a plan B should you need to move money somewhere else and process your transactions.
Yeah, no, that's a really good point. And, there's a lot of really good finance SaaS tools out there now for small companies. So we just switched banks because we switched credit facilities, and all of our AP is processed through a third-party SaaS platform. And we literally just flipped the switch to pull from one bank to another, and, automatically all our processes were set up to go through another bank. So yeah, to your point, if our bank got in trouble, we could easily switch that to another platform like instantly. So looking into those really neat sort of SaaS solutions for small companies, there's a ton of them out there, and they're really making big advancements.
That's great, John. It's I've been through the pain of some bank switches before, and it's what a night and day difference being able to abstract all that into a SaaS tool rather than have to reset everything up. Maybe double clicking a little bit on some of what I think you started with earlier, Kristy. Great to just kind of maybe just give a quick lay of the land of like some of the different like tools and products when you talk about, suite products or otherwise that companies should know about that can both, protect their cash and as well as generate a return, and just kind of considerations and what they're called. So that is, some of the startups that are listening in, can take away from this and kind of know what to ask their bank as they explore this.
I think one of the biggest things is making sure that you understand what is on your bank's balance sheet, right? Because that's what would be at risk if when SVB happened, and all of this is in our filings and you can all read it, how we came to the decision of, out of all of our cash, what was really at risk. It was what was sitting on SVB's balance sheet. And that was a combination of, whatever was in our operating account that day and flowing through other areas, but everything in our sweep account held custody somewhere else, not on their balance sheet. Everything in our investments, our treasuries, and everything at the two other banks that we had held somewhere else, not on that balance sheet and not at risk. So I think the number one thing is to understand from your bank, what is actually on your balance sheet and where can I diversify those funds, but yet leave them to where I have the liquidity that I need at the time that I need it, should I need to make payroll or make a large purchase or something of that nature. So there are, as I described with our second banking relationship, the spread across many banks, of making sure that you only have $250 in each. There are many offerings out there today that are like that. And that would be another place if if you have cash in the bank that you need to spread, that would be another thing to ask. I mean, interest rates are higher now, and so you're going to get yield on it, yield more than the cost that you'll pay. So, the old version of trade-offs of how long do I invest this to get a bigger yield, and then what if I need it in 6 months, right, for something? Those trade-offs are a little bit easier today because the yields are higher. And so, short-term yields are higher. So I would be asking my banker, about how I make sure that I keep all of my funds in some sort of vehicle to where they're as much as possible are insured.
Yeah, and that's one thing that we've definitely seen in the companies we work with, is that, you know, the whole host of products, and we've seen kind of what Kristy was alluding to, ICS insured cash sweep, which is, you know, there are a bunch of networks. One's called IntraFi. That can be kind of like, if you're just waiting to this cash management, a really easy way to both get yield and get insurance, because that chunks your cash out $250 at a time. And, you know, a lot of banks we're seeing pay 3.5% to 4.5% on that. So you're kind of low trade-offs. And, you know, there are other products where we've seen the companies use, you know, Treasury ladders, or, you know, even CD ladders off, you know, or off balance sheet money market funds, which you should talk to your tax folks about before you do that if you're a startup with QSBS stock. But you know, we've seen kind of some of those things too. Some of those can just be a little more involved, especially things like the ladders and things like that. And so you know, there may be a few different ways to kind of end up at the same results from both a yield standpoint and, you know, and an effort standpoint, you know, as well. Yeah, and it'd be great to be, I'm curious, maybe John, what sort of return are you all seeing on your cash? And Kristy, it'd be great to hear about that too, just so that, you know, kind of for folks listening in, that they sort of know what to ask for when working with their bank.
Yeah, and I can't say we've optimized that, because again, we've been hamstrung a little bit because we're stuck with our current lender. But we basically have two accounts. We have a checking account for operational activities, and then we have a yielding money market account that we kind of manually sweep cash between the two. We kind of watch it on a daily basis and move cash around. We're getting like 3.3% on the money market account, and you know, given our cash balance, I think of things in terms of cost of a software developer, right? So the yield on that annually right now is getting us about one software developer. So it's meaningful now when it really hasn't been over the past 10 years. But yeah, it's kind of currently what we're getting.
That's great. What about you, Kristy? What are you all seeing?
Yeah, anywhere from 50 to 150 basis points under the Fed fund rate.
Okay.
So but we also have a larger credit facility at 3 banks, so we have a little more leverage there, which is good. And there's a mix for us, but that's about what we're seeing. And
So the Fed fund rate right now is what, 5.25%. So you're seeing, you know, 4.5%, 4.75%.
Yeah, so it's well, until the next FOMC meeting, I think it's 5.5 now, and that's on risk-free securities with an average duration of about 100 days. So they're short term. Should we, you know, want to make an acquisition or get our hands on, you know, some of our, you know, we're not locked in. So we're not having to make that trade-off right now, which is great.
Yeah. And hey, John, just double quick, you mentioned about kind of your dad and that sort of limiting your options. Tell a little more about that, kind of how that you know, what impact having a credit line's had on your ability to, you know, use multiple banks or otherwise.
Yeah. So again, the past 3 companies I've been the CFO of had credit facilities for each, and each of those credit facilities required us to maintain all of our cash at the bank and all of our banking activities with the bank that gave us the credit facility. And so that is what we are stuck in now. So we have to look at basically the products our current bank offers. Now again, because if you're raising debt, by definition, you don't have a ton of cash on your balance sheet, right? You're kind of using the debt to fund the operation. So it's not a huge problem. But, you know, because interest rates are so much higher than they have been historically, it can spit off a meaningful amount. So I'm actually working with our bank to see if there's any other options internally, looking at what rates their ICS system provides, et cetera, et cetera. But I can't go out to competing banks right now until we make potentially some changes to the credit facility to look at, you know, higher yielding products.
Yeah, it's super helpful. And that's one thing that we've seen is that, I think, John, to your point, historically, most credit facilities for startups required that, you know, all cash was held at the bank, although, fortunately, a lot of the banks that our startups work with, they consider cash that's in an ICS account provided by the bank is held at the bank, or at least they'll give you credit for a large portion of that. And so a lot of times that lets you get kind of the insurance, benefit of chunking it out to different banks while still being within the covenants. But what we did see in the aftermath of SVB kind of the last couple months is banks being a lot more understanding about maybe allowing you to keep 15 or 20% of your cash at a secondary financial institution for resilience. And so that's something as you're looking at credit lines, you should definitely either, if you don't have one, ask about during it, or if you have one, ask for a little bit of grace there. But definitely ask before you do, because you don't want to breach a covenant. But banks, we are seeing be more understanding on that. So maybe one other just kind of thing as we think about cash management. I don't know, maybe Kristy, for you, if you were to kind of really give let's say you were talking to a CEO of a 15-person company that just raised a few $1 million, and they don't have a finance leader. It's the CEO doing finance with an outsourced bookkeeper. And they were saying, hey, I don't want to know a lot about this, but just give me the formula. What would be a formula to kind of shrink this down to a small company? What can I do really simply and easily? What would you tell them?
Gosh, I don't know. And I think John may be able to speak.
Actually, maybe John might be better on. Yeah.
Because I when I joined Alkami, they were so much larger. But I would say the separate ZBA accounts is an enormous, it's very low cost, and it makes things enormously more simple to separate and reconcile for, even for someone who doesn't really enjoy accounting or treasury management, spending their day on that all day. So I do think that a setup like that, where you have everything separated in those ZBA accounts, is very, very helpful.
That's great. What about you, John? What would your advice be for the formula?
Yeah. So I think first thing I would do if I wasn't locked into a credit agreement, I'd definitely have 2 to 4 payrolls of cash in another bank, right? Just for that safety. Other than that, I would just, given I think we're addressing small companies that have kind of part-time or bookkeeper, right? So you don't have a ton of resources to do huge analysis, but I would set up a quick and easy weekly cash flow forecast with whoever's doing the accounting. So you look at the cash flow needs and cash availability over the next 8 to 12 weeks, right? This is sort of outside your longer range forecast model that you're using to talk to investors, and it's more directional. This is like an operational model that knows cash inflows and outflows over the next 8 to 12 weeks, right? We do this. We have a longer range forecast that we're doing planning around, but we also have this 8 to 12 week operational cash model. We do this every week. It probably takes one person an hour to prepare each week, and it takes us 15 minutes to review it, just so we know, again, we're moving cash from the money market to the payroll account, et cetera. So that's one step very small companies can take, and it's not a huge investment.
That's super helpful. Hey, one quick clarification question from the chat. Kristy, you mentioned you're saying ZBA account. Someone just asked you to clarify what that is.
Yeah, they're zero balance accounts, so they always stay at zero. For instance, our payroll ZBA account and benefits, when we process payroll through our payroll processor and the benefits associated with that, they automatically draw on those accounts, and that it has a zero balance. And so they draw it down to a negative, and that overnight is automatically replenished from our operating account. And then from our operating account, if that falls below $1 million, is automatically replenished from that sweep account. So really the only thing we have to do from a cash management standpoint is make sure, and John, to your point, 3 years ago, we were doing the same thing. We were doing a 12-week cash forecast up until we did our Series E and F raises. We were doing a 12-week cash forecast, which took somebody, a couple of hours every Monday to look out at, we're going to pay bonuses. We're going to have a big outflow here. Here's what we expect inflows from our clients. We were doing that as well, but now what we really do is we're able to do a more broad cash forecast and just keep that sweep account with enough money in it that is, of course, safe and in and off the balance sheet of the bank, but provides us that overnight liquidity and whatever we think is going to be drawn down on our operating account. So they're called zero balance accounts. That's what ZBA stands for. And so they just sit there with a zero balance at all times. So there's no money at risk. But if there's ever a draw on it, it won't be rejected because your operating account will fund it.
That's super helpful. Well, one last quick thing, just I'd be remiss if I didn't cover this topic, even though it's not directly related to keeping your cash safe from a bank collapse, but just it's related to keeping cash safe. Any quick best cybersecurity practices you've seen? I know there's business email compromise and other things, and I don't know about you, but I'm constantly getting texts from people that say they're the CEO of a company that say they can't get on the phone but need me to send money somewhere. Anything that y'all do that's real simple to make sure you don't actually send money to someone that's impersonating someone?
Well, we absolutely never wire or send money outside of our normal processes, which means it must go through our disbursement process and our disbursement application, which requires 2 people to approve it. So that can happen. The only way that, and even if we were to wire something, we have dual approval on our wires. As far as email, just getting something processed through, we use Concur for our disbursements, and that requires certain approvals through an approval matrix. Then it's pushed to NetSuite, and that's where the disbursements go out. So there's really no way for us to, even if I received an email from our CFO that said, please, urgently wire whatever, I would not be able to do that. So we do have certain controls set up within our accounting systems as well as our bank that require dual approval. So 2 people have to look at it. But on the cybersecurity, more than that, I would just say training is key. We get so much training from our security office, and they actually send us they intentionally send us emails to try to catch us and trick us. And if you miss one, you get sent to training for 4 hours. So, you pay attention to those. But we have an enormous amount of training from our security team, to teach us how to watch for things like misspelled words in an email and things like that. So training is absolutely key on that.
What about you, John? What do y'all do just to stay safe there?
Yeah, this is an incredibly important part of managing a company these days, particularly small companies, right? Because as Kristy said, the bigger companies put in these really robust processes and the smaller companies often don't. And so, just as examples, I sat on 2 boards recently, and both of those got hit by phishing attacks. One of them, they got control of the controller's email address and were sending emails to the senior accountant to send money, and the company actually sent 100,000 out. They were able to stop it with the bank, but it was a crazy situation where the hacker had control of the controller email account, was sending messages to the staff accountant. When they found out, we stopped the wire, and they were saying, hey, I'm acting as the controller. I'm on the phone with the FBI. The FBI is saying, let the wire go so we can track it. It was like an insane situation. And then the second one, which is interesting, it came from outside the finance operation, a different company, but they penetrated a salesperson's email. They started sending messages to our customers saying, we're changing our wire instructions. And one of those customers sent $200,000 to pay our invoice to somebody else, right? And they couldn't get the cash back. And it caused a problem for us. Now they're refusing to pay us because they said it's our fault because we sent an email from email, right? So this is a huge problem for smaller companies, probably more than bigger companies. And just reiterating what Kristy said, set up robust approval processes, right? That's the key to everything. Any change in a payment outside of those processes basically has to go to me, CFO, right? I'm the one that has to do it. If it came from the CEO, obviously I would call him or meet him face to face and say, why are we doing this outside the process, right? So that set up those processes and do not veer from them. And then second thing Kristy said, same thing, training. Even being a small company, we do a lot of training. Every single person gets trained annually on these phishing things, and the testing is critical. We use a service called Know Before, I think, and it sends fake phishing attempts to our employees, and we have tons of employees clicking on those things. And as soon as they click on them, the IT director calls them, has a conversation with them, talks about the importance of this. And so people are starting to become aware, okay, this is a real problem. So just constant training, emphasis, and then setting up those robust processes that you can't get around.
And
Yeah,
I would
no, we
even,
do. So go ahead.
I would even add, you know, thinking back when we were really small and we had, you know, 6 people in accounting, the thought, part of the training needs to be, it doesn't matter what your role is in the company. If you get something that looks like it's from even the CEO, and I don't care if that's 5 levels above you, you need to be reaching out to your boss or them directly. Don't be shy about asking, are you sure that you sent this, and do it in some way that's not a hit reply. I mean, that's the kind of training that needs to occur, because I think sometimes people who are down, you know, just trying to process transactions, they get a little nervous about questioning the CFO as to whether their request is legit. And so, you know, part of the training really needs to be, no, if this is outside of any of your normal process, you should reach out and ask a question.
Yeah, and one thing I would say, and we kind of take this to heart here too, is like, you know, any new payment instructions or any first-time payment instructions always require a telephone verification. So we always call the person at a number that we've spoken to them before at, and talk to them and read back any sort of payment instructions before any payment goes out. And especially if there's a change, similar process, and just be really just about sticking to processes like that. And it, you know, can really make a big difference, because we've heard some horror stories too. Let's jump in. We got one others, and I know we're running down the clock here, but one thing I also talk about a little bit related is kind of the current capital environment. And when putting this together, Caleb, we tried to put some slides together on debt, since we're talking more about banking, and it was hard to find, but we got some data on just kind of equity, and I think the debt data probably mirrors this in some ways. And so I figured I'd just walk through a few things and then get some perspective from y'all on this. But you know, one thing that we've definitely seen is demand for capital starting to outpace supply. And so PitchBook, some data from PitchBook, they have this like capital demand as a multiple of supply. And so I won't purport to know exactly how they put together the demand supply, but I think you all can see the trend where demand from capital relative to supply has kind of gone up dramatically. And, you know, at late stage, especially venture stage and early stage somewhat, but I think in general, they kind of trail, you know, everything trails a stage above and by a quarter. And so I think in general, we're just seeing demand for capital go up, you know, and with interest rates rising, that's making both debt and equity more expensive, and, you know, there being more scrutiny. So there's one question in the chat about how hard is it to get a line of credit without annual recurring revenue and limited assets. And I would say if you don't have much in the way of assets and you don't have much revenue, it's unless it's some sort of kind of like personally guaranteed SBA loan, it's pretty much impossible. Where we're seeing lines of credit for companies without like hard assets, so software companies, you know, typically are companies that have, you know, at least $1 million or $2 million of recurring revenue, and there's, you know, if you have 2, 3, 4 million, you know, even better. And then just looking at kind of the equity environment, and I think, you know, debt will follow this as well. And somewhat, I don't think this is a surprise. And this is the Q1 data you got to remember is really Q4, because deals get announced a quarter later. And so, but, you know, so if kind of extrapolate the trend, just, the number of equity fundraisers that have dropped as well as the capital deployed. And so, just to kind of summarize what we're seeing, there's still capital available. We are actively investing. We raised our Fund 7 last year, but we are seeing, especially as our companies raise subsequent rounds, et cetera, that the equity markets have slowed down pretty dramatically. Demand has gone up. That's probably increased the demand for debt. There's still a good amount of debt, available. But I would expect there's going to be more and more scrutiny as well for companies raising debt rounds, over the next handful of months. But John, you've been living it. I think you mentioned kind of you've had credit lines and all, and I would just love to get your perspective on what you've seen firsthand in the venture banking landscape around kind of what lenders are doing, what they're interested in, just sort of what you're seeing out there.
Yeah. Well, again, prior to the Silicon Valley Bank implosion, banks were getting very aggressive in the venture lending space, right? And we timed it kind of perfectly. You put our credit facility in place in December, got a really attractive deal, and this is something that's really important to us because it's funding our company right now at very attractive terms. I think it's a little bit too early to tell what the impact of SVB is going to be, and I hadn't been in the market since all of that happened. I've heard anecdotally that some of the other banks are continuing to be aggressive. They're basically trying to capture the market share that SVB had. And SVB was the 800-pound gorilla, for those that weren't aware. I mean, they were by far the largest venture debt lender out there. So it sounds like a lot of the players are trying to fill that hole and try to get as much market share as they can. But again, I haven't been out there talking to them and exactly knowing how the terms have changed. I think it's important to note that the implosion was not related to loan losses in the venture debt portfolio, right? It was related to their deposits and to some extent interest rates in their Treasury holdings, right? So I think that is helping the situation a bit, but yeah, I think we're just gonna have to watch it for a while, Aaron. Unless you've seen other companies out there in the market over the last 3 months, I think it's going to take a little bit more time to understand how the market's changing there.
Yeah, no, we've definitely seen. I think the SVB was a great partner for the community, and we hope that they continue to be under First Citizens. So definitely was not was a bummer, and I do like to say that I think the Texas funds at least were hopefully more supportive of all the banks during that than some of the other funds. But fortunately, there are a lot of options. So we still see SVB under First Citizens, actively working with startups. No particular order: Bridge Bank, Texas Capital Bank, CIBC, Live Oak Bank, Comerica, JP Morgan, PacWest. Lots of options of groups that, and I know I saw HSBC starting something, and I think Citi does a little bit. We have one company with B of A, and so just lots of options for banks that either work with startups and banks that have dedicated kind of startup banking practices. I would say, unfortunately, I don't have a lot of data points in the last month or two on credit facilities either, just from our portfolio. So, but we've definitely seen a lot of banks kind of reaching out, and I think, John, to your point, looking to pick out market share, at least on the deposits and account side, and talking about credit facilities. But I don't have tons of data points. I don't know, Kristy, if you kind of have what you've seen around, if you have any data points around just like from your network or otherwise.
Not really at that level. I will say that we, after what happened with SVB, we immediately shifted or put in place the ability to shift our processes to another one of our banks. We currently have 3 banks in our credit facility, but we're adding another, and one of those will be a large institutional, quote, too big to fail bank or whatever people call it, but, and so we're working on that right now. So we continue to expand our banking relationships as we grow. But as far as, some of the banking credit facility for startups, I also don't have really any anecdotal information from, the last few months.
Yeah, look, any kind of like, and I think the other thing that the broader macro topic is we're obviously in a different cycle than we are a year or two ago. And, a lot of times people speak of these kind of 10-year business cycles of booms and busts and otherwise. And I know, Kristy, you've obviously lived through a few cycles with, Alkami and RealPage before that. Like, any advice just over your, kind of experience of navigating these different kind of changing environments for debt, equity, demand, business cycles, et cetera?
It's hard for me to say that because the companies that I've been at have been at the various times I've been at them, the environment has been different. Our credit needs have been different. Our cash needs have been different. I've also historically been at very acquisitive companies. And so that has driven an enormous amount of our cash needs and made that, not static over time. So I think it really just depends on the company and, and where you are in your life cycle, where you are in your growth, and how you expect to grow, right? Acquisitions or otherwise, and what your cash needs are. So it's kind of hard to say. It's kind of hard to, paint everything with the same brush, if you will.
Yeah. What about you, John? Anything that you've kind of words of wisdom to companies, as we head into kind of this next economic cycle?
Yeah, like Kristy says, very company specific, right? I think the best thing you can do is focus on the product you're selling and the customers you're going after and solving big needs and getting ROI for those customers, right? I think we have that type of product here at LeanDNA, and we did see a slowdown in Q4 and Q1 of this year, but we're still growing very nicely. We're still solving big customer problems. It just slowed down a little bit. Interestingly, we've seen it pick up a bit in Q2, so we're getting a little encouraged by that. We had a lot of delays in Q4 in particular, and even Q1 because of budget issues, but those have kind of opened up for us. So I don't know if that's just specific to us and the deals we're in, but we're seeing things open up a little bit more on our side. So, but again, it's back to kind of focus on what you do, focus on solving big customer problems, and you'll kind of get through it.
Yeah, you couldn't agree more. Focus on the fundamentals and make sure you have the, conserve your capital as you can. So while you focus on those, that you can kind of, get through realizing your value proposition. Cool. This is great. I know we're running up on time a little bit, so I wanted to do a couple of things. First off, before I forget, we actually wrote up kind of a cash management resource along with some of the other startup resources we have. So if you go to s3vc.com/s3-resources, we have a bit of a white paper written up targeted at kind of small companies that have a bit of, a few different sort of recipes that are relatively easy to implement to manage cash. And then we have a whole bunch of other, resources like financial models and, cap table templates and things like that hopefully are helpful. I want to real quick get to a couple of things, in the chat. One question was around kind of vendor payment information. It's held by outside companies. Was one question, or where is it held? And so I think it depends on your setup, but I think, and unless anyone disagrees, chime in, but yes, if you use like Bill, Ramp, Topolti, or S3's portfolio company, Sadozi, got to do a shameless plug for them. A lot of the vendor information can be held in there. And so that's a great way, to John's point, of if you have to quickly cut over banks, the vendor information is kind of sitting on top outside of the bank, and it's real easy. Versus, if you have everything set up in your bank, in their treasury management platform, it's could be a little bit harder. In terms of software to help manage cash flow forecasting and treasury management, or using software or spreadsheets. I don't know if I will again do another shameless plug for Sadozi, but other than that, lots of our companies I know use spreadsheets still. There's some software that's more long-term focused, like Adaptive Insights and things like that. I don't know, maybe John, any software that you use for kind of the cash management forecasting, or is it primarily spreadsheets?
Yeah, for that 8 to 12 week forecast I mentioned, we're doing it in a spreadsheet, although we are testing a tool right now. I'll just mention it. It's called Centime, CENTIME, but we started using it for AR management. They do automated kind of emails for collections purposes, but they have a cash management module that kind of predicts when you're going to get the cash in from their AR module, right? So we're testing it, but I haven't found a great solution in that area yet for the right price point. But like I said, there's tons of innovation in that small company finance SaaS tools, and we're testing one of them right now.
Yeah, great. And so, well, one other thing, I did get a question of what banks are people using. And so I was surreptitiously, as y'all are talking, typing up a quick poll. So I figured we can end this with a poll. And thank you, John and Kristy, for joining us. This was super informative. And for all the banks out there, I quickly did this during this webinar from memory. So I left you off. I'm sure you all are great, and there's no ill will, just kind of doing this in the moment. But I'll launch this up, and would be curious to kind of get a quick snapshot of the different banks folks are using. And I tried to include kind of the regional banks that target early stage companies, as well as some of the larger banks that either just general commercial banking or have an early stage kind of focused practice. All right, I'm going to go ahead and end this and share the results. And so that's what we got. We got and I know there are lots of companies that use some of the banks mentioned that aren't on the webinar today. So I know lots of companies use all these different banks, and for the most part have good things to say about them. And we've had good experiences with most of these folks. But it looks like we still got a lot of folks with First Citizens, SVB, some with Texas Capital Bank, CIBC, PacWest, and then some folks with all the larger banks as well. So with that, I wanted to thank everybody for joining us today. Thought this was super informative. And again, thank you, John and Kristy, for your time.
Thank you all.
Thank you.